gold prices to rise in second half of 2018, experts. Mumbai, India, October 21st. While gold prices are expected to be volatile, bias would be upwards. Sudhesh Nambiath, lead analyst, precious metals for South Asia, GFMS Trail said, gold in dollar terms is on an uptrend and prices are expected to touch $1,350 per ounce next Diwali. In India, the gold market will continue to undergo transformation, as the government is likely to announce a new comprehensive gold policy in the union budget. The new ecosystem is expected to drive gold demand. However, experts caution that the current price of $1,280 an ounce is elevated as price jumped in the last few months as geopolitical issues started emerging but are likely. Gold prices are expected to fall in the first half of 2018 and rise in the second half. Bernard Dada, senior commodities analyst, Global Markets Research, Natixis said, gold prices are expected to come under further pressure in the first half of 2018, as a result of two expected U.S. rate hikes. That said, from the second half on the year, we should expect a slow recovery in prices that will continue into 2019. He expects the end of U.S. rate hikes and further drops in gold mine output to drive prices. However, further geopolitical events should be momentarily supportive of gold prices. Natixis says the high and low for next year will be $1,350 and $1,120, respectively, showing a wide variation. Nigel Arora, a leading global market analyst and author of the newsletter Arora Report, gives a range of $1,180 to $1,420 for next Samvat. Experts advise investors to buy at lower levels in the next few months and sell at the higher end of their range in the second half. There are some factors that will have a bearing on the direction of prices, and clarity is expected to emerge in the next few months. The first one is who will replace U.S. Federal Reserve Chair Janet Yellen after her term expires in January next year. The new chair will decide the pace of interest rate and dollar strength. U.S. President Donald Trump is expected to announce the new chairman next month. Gold is priced in dollars. When the dollar goes up, gold goes down. Dollar, in large part, moves on Federal Reserve's policies. Barring any geopolitical crisis, if President Trump appoints a hawkish chair, gold may go down. A dovish chair appointment may make gold go up, said Arora. He cites the example of John Taylor, a Stanford University economist, whom Trump met this week and is seen as a frontrunner for the U.S. Fed chief post. Arora said, he is known for the Taylor rule, which relates inflation to interest rates. Taylor impresses Trump. The potential of Taylor becoming the next Fed chair is hitting gold and bonds but helping the dollar. The reason, he said, is that under the Taylor rule, interest rates would be much higher. Bonds and gold would go down when interest rates go higher, and the dollar rises when interest rates go up. Another development that is emerging is from Spain, where Catalonia leaders are pushing for independence against the wishes of the national government. Spain is expected to hold a special meeting to use constitutional powers for the first time to curtail Catalonia's autonomy. The issue is serious, because in Catalonia's regional parliament separatist lawmakers are in a majority and plan to declare Catalonia's independence. Catalonia is an autonomous region of Spain with Barcelona as its capital. Dada said, problems in Catalonia could lead to concerns about the stability of Europe and increased demand for a safe haven asset. In such an environment we see gold prices averaging $1,350/oz in 2018 and $1,450/oz in 2019. This is 10% higher than the firm's normal average price projections. Even Focus Economics, a Barcelona-based independent research firm, sees geopolitical uncertainty lending support to gold prices, even as higher interest rates in the U.S. dampen gold's appeal as an investment. For Q4 2018, its analysts panel projects gold prices to average $1,277 per ounce. However, within the panel, price ranges between $1,180 on and $1,350. Back home, several policy changes will continue in the next Samvat. Most importantly, the government has already said that the threshold limit for providing Know Your Customer details under anti-money laundering law will be revised and announced. It has only been kept on hold. This will be a big dampener when it comes. The new gold policy will make efforts to divert gold investments to paper gold, for which several schemes are being finalized, giving flexibility and more options to investors. These schemes, which will be in line with sovereign gold bonds, will give returns in gold price, but there would not be physical gold buying. Niti Aayog's panel for gold policy is expected to submit its report to the Finance Ministry by November 30th, which may be put up for public debate. The gold price forecast 2018 might surprise you. Expect gold price to reach $1,350 to $1,400 an ounce in 2018. The gold price forecast for 2018 cannot but be bullish. It would be reasonable to expect gold prices in 2018 to range in an area between $1,350 and $1,400 per ounce. The gold price predictions for 2018 vary. But, if you avoid unnecessary departures of logic, the level of uncertainty is such that gold prices in 2018 could be even higher than $1,400 per ounce. Gold cannot but increase its appeal in the face of the high uncertainty caused by Brexit. It's far from over, and Theresa May's government, even after an election, remains on the edge of the cliff. The UK will likely endure another election. It could take place next fall, before the end of the year. Meanwhile, the migration crisis in the Mediterranean has pitted Italy, one of the European Union's founding members, against the rest. The unregistered, illegal migrants arrive by the thousands every single day. What does this have to do with gold price trends? Quite a bit, it turns out. Rescue ships from the national navies or coast guards of various nations, complemented by the efforts of do-gooders from NGOs, pick up the migrants near the Libyan coast now. This encourages the phenomenon. But the ships promptly deposit the migrants. Very few would actually qualify as political refugees at Italian ports. The situation is putting pressure on citizens and politicians. It will no doubt force the calling of a general election in 2017 or 2018. The parties that have criticized the illegal migration problem could score a major win. But, it so happens that such parties are the same that advocate Italy quit the EU if the rest of its members refuse to take in migrants and share the problem. Meanwhile, in the United States we have CNN pursuing a political witch hunt against Russia and anyone, it seems, in Washington that may or may not have entertained cordial relations, business, or political exchanges with Russian citizens. The media is putting pressure on President Donald Trump to deviate from his plans to establish a closer relationship with Russia, lest anyone forget, a major nuclear power. One of the potential victims of the media's and much of Congress's anti-Russian efforts is to weaken the tacit agreement for the US or NATO to interfere in Syria's political arrangements. Trump has conceded that Russia has a vital interest in maintaining Assad in power in Damascus. President Macron of France also agrees. But, CNN does not, and neither do many influential but intrusive members of Congress, from Senator McCain to Chuck Schumer. This messy political soup is just starting to simmer now. It could reach a boil by New Year's Eve 2017. This is bad for politics, but good for the gold price outlook. If 2017 has been eventful, 2018 promises to be even more so. The financial world has experienced almost 10 years of a bull market. As a result, there are analysts, bankers, and investors who have known nothing but gains and nothing but near zero interest rates. The trend has taken such root that it has prevented the Federal Reserve from upholding, let alone championing, its much publicized plans to raise the nominal interest rate. The Fed has made 3 consecutive interest rate hikes since late 2015. That has pushed them to 1%. But Chair Janet Yellen seemed uncertain herself that raising rates might be the best policy. The fact that Yellen made it rather clear that the economy is too weak to absorb another rate hike should have sent markets tumbling. Instead, investors, in zombie mode and apparently not willing to believe in anything but the bull market, rushed to buy more. What should have been a sell-off became a shopping spree on Wall Street. In turn, the dollar has suffered, losing ground to major currencies. But, not surprisingly, Gold, which attracts a more conservative type of investor, the kind that has seen it all, started to move up. At the time of writing, the gold price per ounce was trading at about $1,245. It has managed to gain some $30 in a matter of 3 or 4 trading days. There is uncertainty in the air, and the gold price, as usual, reflects this. Everything points to gold prices increasing regardless of the Fed. Gold has actually pulled off a remarkable recovery. Despite reduced price pressure, given the bullish stock market, gold tends to go up when stocks are down, and what might even be a negative environment, gold is moving higher. It's true that the Fed's capping of the interest rate hike program has contributed to accelerating gold's recovery. But the medium and long-term financial, stock market crash, economic, major recession, and geopolitical conflicts with Russia, China, North Korea, Iran risks are such that the long-term gold price forecast is bullish. As a safe haven and value deposit, gold should continue to appreciate during the second half of 2017 in the range of $1,250 minus $1,300. But that's a conservative estimate. There's potential for prices to hit $1,400 or even $1,450 after the summer. If Europe doesn't solve the migration crisis by then, there's the risk of a massive revolt in Italy. That could shake up the very foundations of the European Union, given that Italy is one of the original members of the European political and economic project. That said, even if Italy manages to secure more cooperation from its neighbors and from Brussels, migrants are going to influence even indirectly politics in other EU states. The patterns suggest a higher than expected gold price in 2018. Meanwhile, there are already patterns developing that should sustain gold prices in 2017 and 2018. The US dollar has shown itself rather weak lately. The weakness of the US currency has helped boost the precious metal over the past week in the international market. Standard Chartered Bank has updated its gold price forecast and improved its forecast from $1,200 to $1,300 an ounce for the fourth quarter of 2017. It seems hard to believe. Considering that the gold price per ounce has not traded higher than $1,300 since 2016, few would expect it to reach $1,350, let alone higher, by 2018. According to the report by Standard Chartered, there is a greater chance that the gold price will close the year at $1,300 per ounce rather than $1,200. The gold price is more likely to exceed $1,300 an ounce to take a bearish trend. The fact that the Standard Chartered report was published before the Fed made it clear it would be much more cautious about raising interest rates only makes the $1,300 per ounce mark more credible. There are, of course, other factors affecting gold prices. These range from production shortfalls to yields on U.S. Treasury bonds and taxes on goods and services. For example, Indian authorities have considered enforcing such a tax. But while such a tax applied to gold in India could pose a problem, since its application in June, it has not. Indeed, is going to be more of a temporary obstacle than a structural impact on demand. Among the factors that may lead to a fall in gold prices is the reduction of the Federal Reserve's balance sheet. Then there are also other potential obstacles, including the slowdown in inflation, the reduction in demand in India, beyond administrative risks. Should such factors start to have an effect which should keep gold prices at around $1,200 per ounce, they are no match for the tremendous political risks in 2017, which could overflow into 2018. Moreover, even if Janet Yellen changes her mind, the U.S. Federal Reserve rate hikes have shown they are ineffective. They are no longer crucial to establishing significant declines or upswings in gold prices. Yes, gold did pick up after the Fed assured the markets it would be more cautious about hikes. But, even when investors expected interest rate increases, the gold price outlook remained above $1,200 per ounce. Thus the price floor for gold has gotten higher. The Federal Reserve is expected to hold its third rate hike debate before the end of 2017. But, by then, there may have already been a major stock market crash or a major market correction. The signs of weakness, despite the Dow Jones reaching for new records, are strong. Trump continues to face pressure. The president cannot push through his economic agenda of lower taxes, Frankly, there's little the president can do while his legitimacy continues to be questioned. Thus, there are serious doubts that there will be more rate hikes during 2017 or 2018. Few are optimistic that the Trump administration will be able to push through its fiscal stimulus policy anymore. This should weaken the markets and keep the gold price range much higher than anyone had expected.